Hello and welcome to BloombergQuint. We're in conversation today with Dr. Anantha Nageswaran, a part-time member of the Economic Advisory Council to the Prime Minister and long-time watcher of all things Indian economy and markets. And he is here joining us after a while. So we're going to make this a bit of an open house, talk all things economy. Dr. Van, thanks so much for joining us. Appreciate you taking the time.
Thank you, Ira. It's a pleasure to be back on your show. And of course, needless to add, I'm speaking in my personal capacity. Despite the EAC-PM affiliation. But very happy to be here.
Noted. Let me ask you a broad question, and then we can get into some of the finer points of this. So, as you've seen data come in, how are you viewing the macroeconomic landscape? The broad understanding is that in terms of, the concurrent indicators, you're now back at pre-pandemic levels, but economists would now want to start benchmarking to pre-pandemic trend to try and judge how quickly the economy is repairing, apart from what you can see on the surface. Is that the lens you're viewing it with, or is it something else?
I presume you're talking about the Indian economy,
yes,
right?
Yes.
Okay. No, I think I broadly agree with the way you framed the question. I mean, we should be now looking at the pre-pandemic reference points, and both hard data and anecdotal evidence do give us the impression that things are beginning to fire, if not on all cylinders, but almost all cylinders. So in that sense, I think probably the policy orientation, whether it is particularly monetary, if not necessarily fiscal, should probably veer more towards stability rather than pursuit of growth. Relatively speaking, the pursuit of growth must still be there, but I think the balance probably should be shifting a little bit towards maintaining stability. That is the way I would view it. But definitely, I agree with the general revisions in the current consensus forecast heading towards double-digit growth for 21, 22, etc. So I think we, again, fingers crossed, third wave or third whatever, minor or major, whatever. Notwithstanding that, I think if that turns out to be a manageable one, I have a feeling that we are looking at a fairly good growth in 21, 22 and 22, 23 as well.
Yeah, I'll come to the monetary side in a minute, but I think the question now everybody is asking, so, you'll get somewhere between 9.5% to 10.5% this year, depending on whether you're optimistic or, pessimist. But the question then is that, what is going to drive growth in the next few years? And there's quite a bit of divergence because there are those who believe that, consumption is not going to fire the way it was back in the day. They point to the pre-pandemic sort of flattening out of consumption growth and then question whether private investment will actually pick up or not. I noted that you've written on some of this. You think investment, there's a real chance this time around?
Yeah, I would think so. So, I mean, while I'm in fact relatively more skeptical of the export growth being a big driver going forward, right now for this year, I'm aware that export growth is helping us quite a bit. But given my own concerns about the global economy, partly because of the potential for asset market spillovers there, and asset markets are quite overheated over there as well. So I think given those concerns I have, I'm not even going to bank on export growth. So let's keep that aside. And we know that Indian government in general have limited leeway on the fiscal side from a medium-term perspective. Even if in the short run there is scope to do more, in the medium term they can't do more because we have to focus on the underlying debt stock that we have. So let's keep that also aside. But I am definitely more optimistic about the capital investment cycle picking up. While definitely we can point to the fact that the capacity utilization rates as per the RBI surveys are still somewhat below 70%. But we have to focus on specific sectors. So if you go into disaggregated data, several sectors may be operating closer to capacity, and we also hear anecdotal evidence. And this month, in the September RBI monthly bulletin, we had the old report they used to give us every year regularly on the bottom-up basis of aggregating private sector investment plans, and that has been published after quite a bit of a gap now. And if you look at it, honestly speaking, before the pandemic struck, there was a certain recovery in capital investment that was beginning to happen. The pandemic had kind of put a big spoke in the whole process. But now with the corporate tax cuts, with the growth in profitability, with financial conditions still remaining broadly accommodative, that should kick in. So whether it kicks in to the extent that we had between 2003 and 8, is a matter of debate. Perhaps it would be just as well if it doesn't, so that it becomes more sustainable. But on this concern about private consumption not being a big driver, you go back and take a look at the growth in private consumption before the big capex boom happened in 2003. Consumption growth was much more tepid than what it is now. So I would not go by on the basis of the first fiscal quarter, April, June, and be rather pessimistic on consumption revival, because that came bang in the coincided with the second wave we had. So I'm more optimistic on both the investment cycle and through the employment generation and income growth, that giving a fillip to consumption growth as well happening. So that would be my expectation of the medium-term drivers of economic growth in the country.
You don't think the government will have to lead this cycle, so to speak, via infrastructure? Again, it's not like we've always had fabulous experiences with, government-led infrastructure push, but their current spending is veering towards capex, which is great. But I don't know if, the idea is to push that infrastructure lever and then potentially kick off a cycle based on that.
No, I think that is going to be a very important feature for quite a few years to come. I mean, given so not just for this year, because government capex, I think, has to play a role almost every year until for the next 5 years or so. Yes, I mean, for example, we may have concerns based on track record, but let's also not forget when the Golden Quadrilateral Plan was launched way back in 2002, there was a lot of skepticism expressed at that time as well as whether the government could pull it off. But it did. So I think with so much of digital public goods happening as well on that front, so between digital and hard infrastructure and government's seriousness, which is evident in the way the national monetization pipeline had come through, at least in terms of the intent. And I'm somewhat reassured by the process they had gone through before announcing it, i.e. all the department secretaries and ministries were consulted and they were present when the announcement was made, etc. So these optics do give me an impression that the decision making has been participatory, and to that extent it boosts the potential success of it. And not to mention the new bad bank, which can lead to resolution of assets rather than liquidation, which means you can have some kind of productivity coming out of those assets as well. So if you join all these dots, government capex as well and infrastructure spend can be a relatively more permanent feature of the growth components for the next several years, not just for the current financial year.
Near term, so there's a little bit of some of us are a bit perplexed as to why the government is being fairly conservative even this year. There has been some upside coming in from non-tax revenue, even from tax revenue. Yet there doesn't seem to be a large amount of spend going into the system. Do you have any understanding or explanation of what's going on there?
No, I don't think I have any particular insight, although I would also concede that there is some scope for fiscal relaxation, i.e. in terms of the additional excise duties, etc., that are being levied on fuel consumption. To some extent, if we can boost disposable income, because based on my trip to Chennai and Coimbatore in August, I also noticed, and we all have a tendency to overweight our anecdotal evidence. I shouldn't fall into the trap, but might as well say, there was a certain sense of subdued anticipation of the third wave and some fear and concern. So there is something that is holding back consumption spending. And even if it is not a big fillip, to some extent, if there is a reduction in the additional duties that fuel products are bearing, it's also good for psychology and sentiment. But the finance secretary has gone on record saying that money is available for all capex spending. And in a way, the fact that they are relatively prudent with respect to fiscal is probably also holding back the treasury bond yield from rising further. We are hovering at 6.1%. So they can always claim that that is their contribution to India's growth stimulus by helping to keep the cost of government borrowing at a reasonable level. So, but I would concede that on balance, there is a bit of a scope for targeted fiscal spending towards the bottom half of the K, so to speak, in the K-based, K-shaped recovery. So there is something that can be done.
Things like increased or continued increased Manrega spending, because we've done an analysis internally. Spend is running out, and when spend starts to run out, automatically the supply of those jobs goes down. There is still sort of scarring in the economy, which some of it has to be addressed by the fiscal side.
No, I again agree with you, Ira, because I think this Manrega is in particular a demand-based fiscal stimulus. And the government did say that if there is demand, their initial projection was for a slightly lower Manrega spend this year, because they said as the economy recovers, there'll be a lesser demand. But if the demand arises, they said they would finance it. And we should remember that they have kept some 45,000 crores with the Department of Economic Affairs to meet additional expenditure, and the entire fiscal policy assumptions at 6.8% for the projected budget deficit is quite, I would say, conservative, i.e. realistic, in the sense that it is not something which there is a big risk of a slippage there. And let's also not forget that they did extend the emergency credit line guarantee scheme, both in terms of the timeline and in terms of the underlying guaranteed amounts. It went to, if I'm not mistaken, 4 lakh or 4.5 lakh crores. It was increased. So I think, yeah, so it is not, I would say, it is not as though they have been entirely unsupportive of the need for some kind of a fiscal support, but there can always be a legitimate discussion as to whether they could have done something more, especially for the bottom 50% of the population and the micro and small enterprises.
Let me shift focus to monetary policy, and there is it time to start pulling back, simply. And it's not just about the inflation levels. It is that so much of monetary policy is in emergency mode right now. Is it not time to start winding back?
Well, I read some of your own writings on this, and I know where you stand. My answer is, on balance, yes, we should. I think if we are going to be getting optimistic about growth, then it stands to reason that monetary policy does a little bit of a review, because my concern is that as we say the same thing about the developed world, and with our own experience in the 2011 to 2013 period, when the stimulus overstayed its welcome, both monetary and fiscal, at least this time around, it's not the question of we are firing from a double-barrel gun. But still, I would say it's important to be vigilant, or signal at least that we are becoming more vigilant on the monetary policy front, because overheating, as we learned in the 2008 crisis, isn't only about inflation. It comes through multiple dimensions, and we need to be aware of that, and we need to be cognizant of that. And in order to sustain the recovery, I think, it is good to sort of signal that the monetary policy makers recognize that the trade-off since the August meeting has shifted already somewhat. That signal would be useful and reassuring from a medium-term perspective.
Can you help us? And you've studied this internationally, and I'll come to the global markets in a bit. But how does this extended period of excess liquidity, how does it start playing into asset price inflation? How do we even define asset price inflation in India? And how do we start factoring that in as a risk?
So, for example, if you look at the equity markets, and if you look at the cyclically adjusted PE ratios, India's equity market is the second most expensive after the United States, according to many metrics. And then from a structural perspective, we all know that the real estate market, although last year wasn't a big increase in the residential real estate prices in India, so on a structural basis, we are still one of the most unaffordable markets in terms of the ratio of home prices to GDP per capita or incomes, etc. So I think there is always a certain element of excess demand, either due to monetary or due to regulatory policies. We have those structural rigidities which lend us to a slightly higher risk of overheating more quickly than other economies. So I think to that extent, monetary, I'm not saying the answer lies in higher interest rates. It could be a combination of interest rates or macroprudential measures, or some kind of risk weights being adjusted, just as it was adjusted for consumer loans in the right direction, last year or the year before. Maybe the time has come to look at some of these risk weights in the other direction. We just need to become more flexible about these. So I think the overheating definitely is indeed happening, if not in terms of FII flows, in terms of the amount of subscription you are getting for IPOs. And these CAPE ratios, etc. And there is plenty of anecdotal evidence as well in terms of retail participation, etc., and so on. So policymakers obviously have to rely, as always, on a lot of their own judgment in coming to these conclusions. We can't always go by very well-defined quantitative metrics here.
No, absolutely. On the inflation, the pure sort of consumer price inflation side, what's your thinking? I mean, at one level, the point made by Dr. Michael Patra was completely valid, that you can't disinflate very quickly. There is obviously a growth sacrifice there. On the other hand, I think the point that I raised in my article as well is that, is it now for the RBI to lay down that disinflation path? Whether we like it or not, we do have an inflation targeting framework now.
As you laid out, what did you say about that? Is it RBI?
Is it for the RBI to lay down that disinflation path? My point was that we have an MPCV, and again, in the emergency period, we may have been justified in veering away from the letter of the inflation targeting framework. But as that emergency passes, we have to start restoring the credibility of it, or it will be like the FRBM framework.
No, I remember now that you mentioned it. Yes, I remember reading it in your piece, and also I read the text of Mr. Patra's speech, which you had referred to also in your article. Look, I mean, whether they are making a mistake or not is something. So to be honest, we can also say we can't say with any amount of certainty. While there is a possibility that it could be a mistake, but obviously both of us would be able to figure out only after the fact. But I remember Dr. Subbarao talking about way back in 2010-13 period. His problem was not so much that he didn't tighten in time, which became evident in hindsight. But here he was going to every G20 meeting and them talking about continuous strains in the Eurozone. Continuous strains in the US economy. If you remember, in 2011 or 12, the US did some Operation Twist and extended their QE program. So you go there, you attend the G20 meeting, and you hear all of them still talking only about growth risks rather than having to normalize. Then you also start to wonder, what if I end up making a mistake by normalizing too early? So I think to some extent it did influence his thinking. So similarly now, as even if they have, let's say, inclined to give signals to the Indian market about normalization sometime soon, suddenly they hear about this Evergrande thing happening. Yeah. And then the possibility of spillover into other emerging markets, particularly in Asia, etc. Although in the India's case, one could actually argue that it might work out to be in India's favor. So rather than that being a dampener, it could be an additional stimulus in that sense. So I have a feeling, therefore, these considerations must be weighing on them. But I agree with you that once you have a framework, while I have written enough about the inflation targeting framework and its limitations, I'm not a votary of it. But if you have a framework, then you might as well sort of err on the side of caution in the market, interpreting that you have become relatively lax about it. That impression we should not build up. Then it would be probably more appropriate and consistent to even then formally sort of move into a different framework. But once you have it, if we take a very elastic definition of it, then the risk for an emerging economy is that it stretches credibility. And unfortunately, the reality is that financial markets do treat emerging economies and developed economies differently in this matter.
So I have one more question, slightly tangential, but I'm really curious to hear your thoughts before I move on to the global side. There seems to be a lot of excitement around the global bond listing, and I know we have tried for that for years, and it may soon happen. What's your sense of the balance here of benefits to risks? It's still not clear to me as to whether the flows would be within that 6% macroprudential limit for holding of government bonds by foreign investors. But that aside, it's a double-edged sword, no?
Is it what double-edged sword?
Yeah.
Well, I mean, Perhaps right now, I would say the positives outweigh the negatives given our infrastructure funding needs. And once again, I would say, given what is going on in China, at the entry of India, and I think we saw some recent note by a broker that only one particular set of Indian bonds may be eligible.
The 10-year. The 10 years, so the benchmark.
Yeah. So the amount of money that we may be attracting may not be that big because the overall size would be relatively limited. So, and given what's going on in China and given our own infrastructure spending plans that we discussed, on balance, I would say it's probably a positive thing. But I have my own personal views on whether bond markets ever really help an emerging economy achieve a higher capital formation and higher economic growth rates post inclusion in an index. Is there any formal study which can say for an emerging economy, this is the reality pre-inclusion into a bond index and post-inclusion into a bond index? Is there any formal study? Are you aware of it?
No,
that is what I'm asking all the people. Not so much because I'm a skeptic. I really would be very happy to know, for example, for Indonesia or Brazil or anybody, because we know from the experience of European economies in the 50s and 60s, bank funding did play a big role in their infrastructure investment needs and so on. And also, I'm a bit concerned about the shrinking horizons of financial market investors in general, whether it is equity or bond market.
Time horizons?
Shrinking horizons. I mean, the holding periods of a typical equity market investor used to be several years in the 50s and 60s and 70s. Now it is less than a year on average. I mean, so very seldom you have investors taking the long view. And if it is simply a case of a carry trade for emerging market bond investors, given the likelihood of sort of a perpetual low interest rates in the developed world, then I really wonder whether it would, in the long run, be a net positive or not. But I think in the short run, given the circumstances that are prevailing in the neighborhood, I would give it a cautious welcome.
Understood. Let me switch to global markets a little bit and markets as well. A big Powell speech coming up, or big FOMC meet coming up. So we'll see how that goes. But again, globally and especially in the US, time to start pulling back. I think some people have said that this time you're being too cautious and perhaps delaying or staggering the taper a bit much. Your own thoughts, and I know you've studied this a lot.
No, I think they have a good excuse not to taper. They can point
because
to
of Evergrande.
Sorry?
Because of China.
Because of Evergrande and the global spillover, they might say, no, it's probably the moment has passed. So even if they were going to taper, I never believed that it would be anything permanent, because I think they have gone too far deep into this easy monetary policy setting that I always thought it would be maximum a 1 quarter affair before they slip back into a state of perpetual accommodation. That's because, here is a recession that in the United States supposedly lasted 2 months in April, May of 2020. And then you have had these policies, including asset purchases and low interest rates prevailing for another 20 months or so, 17 or 18 months or so. So, and I think so in the process, whatever addiction we built up for easy money post 2008 has just simply grown too big, both from the policymakers' point of view and from the market point of view. So I don't think really they can do any kind of meaningful taper, any kind of meaningful normalization. I think that boat has sailed off a long time ago. So it would be very fleeting if they do so, and they would revert back to. So this thing has to reach its logical conclusion, and we may have to end up with a global monetary regime reordering by the end of the decade. I think that's where we are heading.
The inflation picture in the US, you don't think will force a change this time around? There are a lot of believers that the nature of fiscal stimulus will mean that the inflation picture this time is very different from what we have seen in the past.
In the United States?
In the United States, yeah.
Oh, I think, I have a feeling that they believe that the fiscal stimulus is something that is not going to cause a meaningful increase in the cost of capital. And therefore, I don't see them pulling back on this double-barrel stimulus approach that they have embarked on. And both the political discourse and economists who are attached to the current government, I don't think they are looking at restraint and prudence at all in the near term. They feel this is a costless exercise. And I must tell you, that I looked at the budget that the President Biden sent to the Congress earlier this year, and for the first time, I went back and studied the previous 20 budgets or so. The first time the Treasury makes a projection for the real rate of interest in the United States to remain negative all the way through the end of the decade. Because they have to give a 10-year projection. This is part of their document that they have to send to the Congress. And whether they are sending a signal to the Federal Reserve or this is what they expect, I don't know. But they project negative real rates for the next until 2030, which has never been the case before. I mean, so I think normalization of fiscal and monetary policy in the United States will probably require a very big jolt to the US dollar, which I can't see happening at this point in time because of what's going on in Europe, because of what's going on in China. This TINA factor is still operating in dollar's favor. But that is the jolt that will be required for the United States to get back to discover a Paul Volcker in its midst. But that will take a long time. Yeah.
Okay. So in the interim, markets, global and local, continue to be on steroids, so to speak.
Well, on the face of it, yes, but we all know that bubbles never last forever. Otherwise, they wouldn't be called bubbles. I mean, they have to burst. So if it is not monetary policy, I'm sure some accident will happen. That will eventually pop the bubbles elsewhere. So I think the asset market overheating risk is my biggest concern, both globally and therefore the spillover locally into India as well. These remain my top concerns.
Before I run out of time, and I know this requires a longer discussion, but you have an interesting article today on the fads that central bankers are following, whether it's the inequality debate or the green financing. I think the inequality part is more interesting, and the distinction that you draw on wealth inequality, which through these sort of bubbles, if you want to call them, or large rises in stock markets, has something that has been a feature of their policies for a while now.
Oh, indeed. I think I would say this is a case of sort of talk the talk but not walk the talk. So if central bankers keep talking about inequality, that's kind of give a signal to the politicians that they indeed are very conscious of what they need to do. But the truth remains that their policies have indeed contributed to the wealth inequality through the equity market principally. And it is not just me who's saying it. As I mentioned in the article, BIS mentioned it 5 years ago. And the House of Lords Economic Affairs Committee, headed by none other than Mervyn King, the former Bank of England governor, who actually did institute QE in that country. And they are saying, at least have a discussion about the trade-offs. That is not happening. And I think, therefore, if they really want to address inequality, ending QE is the answer. And on climate change, yes, even less said the better. I mean, they don't have the tools, and they don't have the mandate nor the tools to address that. It is really mission creep.
I'll have to leave it at that. Longer chat pending on that last issue. But thank you so much, Dr. Anantha Nageswaran, for joining us. Free-flowing chat on all things economy. Appreciate your time.
You're welcome. Thank you, Ira. Nice talking to you again.
Thanks for watching.
Bye.